It's a question I get all the time. Should I invest when the market is at all-time highs? Let's be honest, no one wants to invest and then see 30%, 40%, maybe even 50% drops due to just incredibly unfortunate market timing. And the market feels quite buoyant right now, right?
We got S&P record high, NASDAQ up 5 in a row, first time since January. VIX
So by the end of this video, I'm going to go over some key facts that you need to be thinking about if you're worried about the market being all-time highs. I'm going to tell you some things you probably weren't expecting about investing and give you some strategies to consider. So let's go. And firstly, like any financial planner, what I would say to my clients with investing is be prepared. Just, maybe not in that way or with the weird overtones. But anyway, the thing is, volatility is not a bug of the market, it's a feature. You have to understand that if you want to take the positives from the market, what's called the risk premium, you have to accept the ups and downs that come with it. But just to explain how bad it can get, if you were invested in just the FTSE All-Share, which is a reasonable proxy for the UK market, in 1970, the peak to trough decline was 67% over 2 years. That is horrific. And an argument for global diversification, which could have helped hugely, and also making sure your personal finances are set up right so that you could sit it out and benefit from the eventual return in the market. But with all that in mind, surely it's worth holding back a bit of money until the time's right. So do we actually know what a high market is? So let's firstly see if we can define what a high market is. You could argue it's the difference between the price and value. And because what stocks are the discounted value of future cash flows. If you pay a higher price for these cash flows, which is what the stocks deliver, then the returns, all things being equal, would be expected to be lower. So of course, when you're seeing headlines of the markets being at all-time highs, surely that means that the prices kind of must spring back soon. Right, so let's unpack that and let's see if it makes any sense. This is Cliff Asness from AQR, who are a very large asset manager, and he wrote the paper Market Timing Sin a Little to try and figure out if you could use higher valuations in the market to trade and profit. Now, they use what's called the cyclically adjusted price to earnings ratio, or also known as CAPE. So what this is stock prices in general are judged divided by the average of 10 years earnings adjusted for inflation. So it kind of smooths out the overall pricing. And because it's the average over 10 years, it's better for showing long-term pricing trends instead of like 1 year, which could be different for a ton of reasons. And then if we look at the overall market, for example, the S&P as a guide for the US market, we can see if the price is high or low compared to history. Well, let's have a look at this graph here. On the left is where the prices are the highest, and on the y-axis is the excess returns. You can see that the returns are higher when the price is generally cheaper. So sure, you're thinking, oh, okay, so timing the market does make sense then. Well, hold on a minute. In the research from AQR, they then used this data in the model, which was used as a timing signal of high or low prices, to check and see if they use that in the model, if it delivers better risk-adjusted returns. The results of the model, it didn't work very well. In fact, it underperformed just buying and holding the investment. And this shows you the reason. Basically, when timing was brought into the play, it meant that for long periods they were underinvested. In fact, since 1958, it was underinvested by 11% at only 89% invested. This, I think, is really interesting and telling because it sort of speaks to the heart of the problem. And from what I see from investors who try and time these things, you kind of almost inevitably end up underinvesting, waiting for a crash, which almost certainly will arrive, by the way. But the thing is, me, you, any financial or media commentator doesn't know when that's going to be. To quote the legendary investor Peter Lynch, far more money has been lost by investors preparing for corrections than has been lost in the corrections themselves. At its core, it shows that values can drift a certain way for years or even decades. And another thing when looking at any chart and trying to extrapolate, it's sort of the financial equivalent of the gambler's fallacy. This is where you go up to a roulette table and you see 5 reds landing in a row. And that's a gambler's fallacy that you think the chance of getting a black next is high. Actually, nothing's changed. It's still the same odds when you start when the ball rolled. It's just that you're extrapolating on the past results and thinking you're going to have a result of the next roll. This was highlighted in Credit Suisse's yearbook as well. and the problem of what's called trendline illusion. And I'll show you now kind of what I mean. It's basically being able to draw an obvious trend line in hindsight, but not as easily with foresight, because remember, we don't know future returns. So if I was to draw a trend line here, at this point, the whole thing seems obvious. But at this point, it isn't. And this is kind of what it's like being in the stock market. We can only really define what is cheap or expensive with hindsight. To quote the research, prices may look cheap compared to recent years, and simultaneously expensive versus their long-run average. Or they may look cheap in one country and expensive in the other. But we cannot know in advance what valuation level is going to prevail at some point in the possibly very distant future. So in a nutshell, we don't really know what a high market is, and we don't know whether a high or low market can prevail and for how long. And let's go over the problem with trying to time. There's also a less appreciated issue here that you need to consider. Assuming that you initially wanted to be invested in the market because you want to grow your wealth, and that remains your goal, if you come out of the market, you better have a very specific framework of how to get back in. Because the initial question of the markets are at an all-time high, is now a good time to invest, will be followed by the less attractive sibling, which is it a good idea to invest when the market's falling? The question is, when you are out of the market, when do you decide to get back in? The point is the person who's really worried about the markets being too high going to be the same person who boldly invests when everyone around them is screaming sell and all the news outlets are saying it's going to get worse? Which, by the way, spoiler alert, always happens. And just to top this all off, when asset manager Dimensional looked at the S&P 500 when it had just surpassed all-time highs previously, and they had a look at when it declined 10%, aka, a buying opportunity. Well, they found that when doing the forward returns, the market was actually higher a year ahead once it had gone past all-time highs instead of after the decline. It was also higher for years 3 and 5. You've invested then instead of the decline, you would have historically had a better return. And that's, remember, when the buying opportunity was perfect from the investor. Now, clearly this is just data, and past performance isn't a reliable guide of future returns. But the data on the conventional wisdom isn't looking good. So just before I go into the next bit, both these topics were addressed in my blog posts. Should you worry when markets are all-time highs, and invest now or wait? And here is the link to follow my blog. Why not join the mailing list, principlespersonalfinance.co.uk, 1 email a week on this stuff and no spam ever. So what can you do? So let's say you're still concerned. Let's go over some things you actually can do. One is get honest with yourself. And I know that sounds trite and not helpful, but one of the big things that isn't talked about on YouTube with all these YOLO traders is it's totally okay not accepting very high volatility if you don't think you're comfortable with it. There's nothing wrong with being like, actually, do you know what? I think I would struggle a 30-40% decline. And that is historically really, really bad for being invested in equities, but it has happened. I think what's much worse is pretending to be fine on the abstract concept and then realizing when it does happen, you can't stand the heat. Investing is a discipline, and within any discipline, you have to know yourself. So what I do with my clients is help them find money peace of mind. And what that isn't about being up late at night worrying about your investments. You do have to understand there are always ups and downs with investments and cater your risk appropriately. Number 2 is assess your circumstances. So the best investments are those that can be held for many, many years. So you need to make sure as much as possible that you don't dip into them. And you could watch my video, 5 Steps to Financial Control, for a guide on this. But if you don't have an emergency fund which is sufficient, and if you haven't protected your income, you're vulnerable and needing to dip into it at the worst time. And the final one is pound cost averaging. So this is another option, and where instead of investing in a lump sum, you drip it into the market. The idea being is that you avoid the big drops by buying in stages. So you might buy less units when the market's going up, but take advantage when the market goes down. Sounds good, doesn't it? Well, there is a problem. When we test the historic data, generally it doesn't support this being a better strategy mathematically, and it only really provides one thing, which is a bit more emotional control. And it doesn't actually remove the problem either. Let's have a look at this graphic. Let's say that instead of investing here, you decide to be all in now, and you've been dripping here, here, and here. Now you're all invested. Is that any better? It is just market timing at the end of the day. So to summarize, we don't actually know what a high market is. Even if we did, we'd never be able to time it. And even if we did time it, the data isn't particularly convincing that would help. So any actionable strategies are always personal, to be honest with yourself, Make sure you've got sufficient cash buffer and you're adequately protected. And if all else fails and you're still not comfortable with that, pound cost average. But the key thing is to make sure that the risk is right for you. The truth is, no advisor, no investor, and certainly no market commentator knows when the market will pull back or push forward. If you're willing to sit some ups and downs out and you've built a strong enough financial plan that will enable you to do this, you can understand there's one thing the history of the markets tell us: timing is not everything.